Introduction to crowdfunding, real estate. Crowdfunding real estate involves pooling small investments from a large number of individuals to finance property development or acquisition projects. This innovative financing method has democratized real estate investment, making it accessible to a broader range of investors who might otherwise be excluded from traditional, high-entry barrier opportunities. It leverages online platforms to connect developers seeking capital with investors looking for real estate exposure. The process typically involves a developer listing a project on a platform, providing detailed information, and soliciting funds from the crowd. This approach offers a powerful alternative to conventional bank loans or private equity, fostering greater transparency and community engagement. Understanding its fundamentals is crucial for navigating this evolving financial landscape. The digital nature of crowdfunding streamlines many aspects of the investment process. Evolution of real estate investment. Historically, real estate investment was largely confined to institutional investors and wealthy individuals due to significant capital requirements and complex transaction processes. Traditional methods included direct property ownership, real estate investment trusts, REITs, and private equity funds, each with its own set of advantages and limitations. The advent of the Internet and subsequent regulatory changes paved the way for more inclusive investment models. These technological advancements enabled the creation of platforms that could efficiently aggregate capital from numerous small investors. This shift represents a significant democratization of access to real estate assets, moving away from an exclusive club to a more open marketplace. Understanding this evolution helps contextualize the rise and importance of crowdfunding in today's real estate market. It highlights a broader trend towards financial inclusion and digital transformation. Benefits of crowdfunding for investors. Crowdfunding offers several compelling advantages for individual investors, making real estate more accessible and diversified. Firstly, it significantly lowers the entry barrier, allowing investments with smaller capital amounts than traditional methods. This enables investors to participate in high-value projects that were previously out of reach. Secondly, it provides diversification opportunities across various property types, geographies, and risk profiles, reducing overall portfolio risk. Investors can choose from residential, commercial, industrial, or mixed-use projects. Thirdly, crowdfunding platforms often offer greater transparency, providing detailed project information, financial projections, and regular updates. Finally, it allows investors to directly select specific projects they believe in, rather than relying on a fund manager's discretion. This direct involvement can be empowering and educational. The potential for attractive returns also draws many individuals to this model. Benefits of crowdfunding for developers. For real estate developers, crowdfunding presents a powerful alternative to traditional financing, offering speed, flexibility, and broader reach. It can accelerate the funding process compared to securing conventional bank loans, which often involve lengthy approvals and stringent requirements. Developers gain access to a wider pool of capital, reducing reliance on a few large institutional investors or a single bank. This diversified funding base can also lead to more favorable terms and conditions. Furthermore, crowdfunding campaigns can serve as a marketing tool, generating public interest and pre-sales for a project, effectively building a community around the development. The direct connection with a large investor base can also provide valuable market feedback and validation. This method empowers developers to maintain greater control over their projects and avoid diluting equity excessively. It's a strategic tool for efficient capital raising. Understanding securities regulations. Real estate crowdfunding operates within a complex web of securities regulations designed to protect investors and ensure market integrity. These regulations vary significantly by country and jurisdiction, making it crucial for developers and platforms to understand the specific rules applicable to their operations. In the United States, the Securities and Exchange Commission, SEC, oversees these regulations, primarily through acts like the Jobs Act of 2012, which introduced key exemptions for crowdfunding. Other countries have similar regulatory bodies and frameworks, such as the Financial Conduct Authority, FCA, in the UK. Compliance with these laws is non-negotiable, covering aspects like investor eligibility, disclosure requirements, advertising restrictions, and reporting obligations. Failure to adhere to these rules can result in severe penalties, including fines and legal action. A thorough legal review is always recommended before launching any crowdfunding campaign. Accredited versus non-accredited investors. Securities regulations often differentiate between accredited and non-accredited investors, imposing different rules for each category. An accredited investor typically meets specific income or net worth thresholds, indicating a higher capacity to absorb potential investment losses. For example, in the US, an individual must have an annual income of over $200,000 or $300,000 with a spouse for the past 2 years, or a net worth exceeding $1 million, excluding primary residence. Non-accredited investors do not meet these criteria and are generally subject to greater protections and investment limits. These distinctions are crucial for developers when structuring their crowdfunding campaigns, as certain exemptions, like Regulation D Rule 506C, are only available for offerings to accredited investors. Other regulations, such as Regulation CF, allow participation from non-accredited investors, but with strict investment caps. Understanding these classifications is fundamental for legal compliance and targeting the right investor base. Key crowdfunding regulations, e.g., Reg A+, Reg CF. Several key regulations govern real estate crowdfunding, each offering different avenues for capital raising with varying investor eligibility and disclosure requirements. Regulation A+, Reg A+, allows companies to raise up to $75 million from both accredited and non-accredited investors, subject to SEC qualification and ongoing reporting. It is often referred to as a mini IPO due to its public offering characteristics. Regulation crowdfunding, Reg CF, permits companies to raise up to $5 million from both accredited and non-accredited investors within a 12-month period, with specific investment limits for non-accredited individuals. This regulation has lower compliance costs than Reg A+, but also has a lower funding ceiling. Another common exemption is Regulation D Rule 506C, which allows unlimited capital raises but restricts offerings to accredited investors only, permitting general solicitation. Developers must carefully evaluate these options to choose the most suitable regulatory path for their specific project and target investor base. Each regulation has distinct implications for marketing, legal costs, and investor reach. Compliance and legal due diligence. Ensuring strict compliance and conducting thorough legal due diligence are paramount for any real estate crowdfunding venture. This involves meticulously reviewing all legal documents, permits, environmental reports, and financial statements related to the project. Developers must verify clear title to the property, assess any existing liens or encumbrances, and ensure all zoning and land use regulations are met. For the crowdfunding campaign itself, platforms and developers must prepare comprehensive offering documents that accurately disclose all material risks, financial projections, and terms of the investment. This includes ensuring all marketing materials comply with advertising rules and avoid misleading statements. Engaging experienced legal counsel specializing in securities and real estate law is essential to navigate these complexities. Proper due diligence protects both the developer from future liabilities and investors from potential fraud. It builds trust and credibility within the crowdfunding ecosystem. Equity crowdfunding models. Equity crowdfunding models allow investors to purchase a share of ownership in a real estate project or the entity that owns it. In return for their investment, individuals receive equity, which typically entitles them to a share of the project's profits, such as rental income, and a portion of the proceeds from a future sale or refinance. This model aligns investor and developer interests, as both benefit from the project's success and increased property value. Investors become partial owners, similar to shareholders in a traditional company. The returns are often tied to the long-term performance and appreciation of the underlying real estate asset. Equity crowdfunding can be structured in various ways, including direct equity in a specific property or through special purpose vehicles, SPVs, that own the property. It offers potential for significant capital gains, but also carries the inherent risks associated with property ownership and market fluctuations. Due diligence is critical for assessing the project's potential and the developer's track record. Debt crowdfunding models. Debt crowdfunding models involve investors lending money to a real estate developer in exchange for regular interest payments and the eventual repayment of the principal. In this scenario, investors act as lenders and the developer acts as the borrower. The investment is typically secured by the underlying real estate asset, providing a level of collateral for investors. Common forms include mortgage-backed loans, mezzanine debt, or construction loans. Investors receive fixed income streams, making this model attractive to those seeking predictable returns and lower risk compared to equity investments. The terms of the loan, including interest rates, repayment schedules, and maturity dates, are clearly defined in the offering documents. While generally less volatile than equity, debt crowdfunding still carries risks, such as borrower default or project delays. Thorough due diligence on the developer's financial health and the project's viability is essential. It provides a structured way to participate in real estate finance without direct ownership stakes. Hybrid crowdfunding structures. Hybrid crowdfunding structures combine elements of both equity and debt models, offering a flexible approach to real estate financing. These models are designed to cater to a broader range of investor preferences and project needs, blending the potential for capital appreciation with the stability of fixed income. One common hybrid is convertible debt, where a loan initially provides interest payments, but can convert into equity at a later stage, often upon a specific event, like a successful project milestone or a future funding round. Another example is preferred equity, which offers a fixed dividend payment before common equity holders, along with potential for additional returns. These structures can be particularly attractive for projects with higher risk profiles or those seeking to optimize their capital stack. They provide developers with more nuanced financing options and investors with tailored risk-reward profiles. Understanding these blended approaches is key to advanced crowdfunding strategies. They allow for greater customization and adaptability. Direct versus platform investments. Real estate crowdfunding can occur through direct investments or via specialized online platforms, each with distinct implications for developers and investors. Direct investments involve developers raising capital directly from their network or through private solicitations, often relying on existing relationships. This approach offers greater control over the investment terms and potentially lower fees, but it requires the developer to manage all aspects of legal compliance, investor relations, and administrative tasks. It can be resource-intensive and limits reach to a smaller, known investor pool. Platform investments, conversely, leverage established online portals that connect developers with a broad base of pre-vetted investors. These platforms handle much of the administrative burden, including legal documentation, payment processing, and investor communication. In exchange for fees, they provide wider exposure and streamlined processes, but developers must adhere to the platform's specific terms and conditions. Investors benefit from the platform's due diligence and standardized offerings. Choosing between direct and platform approaches depends on the developer's resources, network, and desired level of control. Each method caters to different strategic objectives. Identifying viable real estate projects is the cornerstone of successful crowdfunding, requiring a keen eye for market potential and a rigorous evaluation process. Developers must seek properties with strong fundamentals, including desirable locations, clear development potential, and alignment with current market demands. This involves analyzing demographic trends, economic indicators, and local planning regulations. Projects that offer a compelling narrative and clear value proposition are more likely to attract investor interest. Consider factors such as existing infrastructure, access to amenities, and future growth prospects. Furthermore, the project's financial projections must be realistic and supported by solid data, demonstrating a clear path to profitability for investors. Avoid projects with excessive regulatory hurdles or unmitigated environmental risks. A viable project is not just about a good idea. It's about a well-researched and strategically positioned opportunity. It requires a blend of market insight and practical feasibility. Market analysis and feasibility studies. Comprehensive market analysis and feasibility studies are critical steps in validating a real estate project's potential before launching a crowdfunding campaign. Market analysis involves examining supply and demand dynamics, rental rates, property values, and competitive landscapes within the target area. This research helps determine the optimal product type, pricing strategy, and target demographic for the development. A feasibility study then assesses the project's practical viability, considering factors such as construction costs, regulatory approvals, infrastructure requirements, and potential revenue streams. It evaluates whether the project can be completed within budget and on schedule, and if it will generate sufficient returns to satisfy investors. These studies often involve detailed financial modeling, risk assessments, and sensitivity analyses. Presenting robust market analysis and feasibility studies instills confidence in potential investors and demonstrates the developer's professionalism. They are indispensable for making informed decisions and mitigating risks. Without these, a project is built on speculation rather than solid data. Financial modeling and projections. Robust financial modeling and realistic projections are paramount for attracting investors and demonstrating a project's potential returns. This involves creating detailed financial statements, including pro forma income statements, balance sheets, and cash flow analyses, spanning the entire project lifecycle. Developers must accurately forecast construction costs, operating expenses, rental income, and potential sale prices. Sensitivity analysis should also be performed to understand how changes in key variables, for example, interest rates, occupancy rates, might impact profitability. These models must be transparent, well documented, and based on credible assumptions, supported by market data and expert opinions. Overly optimistic projections can erode investor trust and lead to dissatisfaction. The goal is to present a clear, conservative, yet attractive financial picture that allows investors to make informed decisions about the risk and reward. This detailed financial roadmap is a key component of any successful crowdfunding offering. It provides the quantitative evidence investors need. Risk assessment and mitigation strategies. Every real estate development project carries inherent risks, and a transparent assessment, coupled with robust mitigation strategies, is crucial for investor confidence. Developers must identify and analyze all potential risks, including market fluctuations, construction delays, cost overruns, regulatory changes, and environmental liabilities. For each identified risk, a clear mitigation plan should be outlined, demonstrating how the developer intends to minimize its impact. This might involve securing comprehensive insurance, establishing contingency budgets, pre-leasing agreements, or diversifying funding sources. Transparency about risks is not a deterrent, but a sign of professionalism and trustworthiness. Investors appreciate a realistic portrayal of challenges and a well-thought-out strategy to address them. A detailed risk matrix, outlining likelihood and impact, can be a valuable tool in offering documents. Effective risk management protects both the project's viability and the investor's capital. It's about proactive planning, not just reactive problem-solving. Crafting the investment offering. Crafting a compelling investment offering is paramount to attracting and securing capital through crowdfunding. This involves developing a clear, concise, and persuasive narrative that highlights the project's unique selling points, market opportunity, and potential returns. The offering document must include all legally required disclosures, detailed financial projections, a comprehensive risk assessment, and a clear explanation of the investment structure, equity, debt, or hybrid. High-quality visuals, such as architectural renderings, site plans, and team profiles, are essential to engage potential investors. The language used should be professional yet accessible, avoiding overly technical jargon where possible. A strong call to action and a clear outline of the investment process will guide interested parties. The goal is to build trust and excitement, while also providing all necessary information for informed decision-making. A well-crafted offering is the project's primary marketing tool. It bridges the gap between the developer's vision and the investor's decision. Setting funding goals and timelines. Establishing realistic funding goals and clear timelines is a critical strategic decision for any crowdfunding campaign. The funding goal must be sufficient to cover the project's capital requirements, including acquisition costs, development expenses, and a reasonable contingency. It should also be achievable within the chosen regulatory framework and market conditions. Setting an overly ambitious goal can lead to campaign failure, while an insufficient goal may leave the project underfunded. The timeline for the campaign needs to be carefully planned, balancing the urgency of capital raising with sufficient time for investor outreach and due diligence. Typical crowdfunding campaigns range from 30 to 90 days, but this can vary. Clear milestones and deadlines for both the campaign and the project itself should be communicated to investors. A well-defined funding strategy, including minimum and maximum targets, provides transparency and instills confidence. This strategic planning ensures the campaign is both effective and efficient. It guides investor expectations and operational execution. Marketing and investor outreach. Effective marketing and targeted investor outreach are crucial for the success of any real estate crowdfunding campaign. This involves developing a comprehensive marketing strategy that leverages various digital channels to reach potential investors. Social media platforms, email marketing, content marketing, blogs, articles, and online advertising can all play a vital role in generating awareness and driving traffic to the offering. The marketing message should clearly articulate the project's value proposition, highlight its unique features, and explain the investment opportunity in an engaging manner. Building a strong online presence and actively engaging with potential investors through webinars, Q&A sessions, and direct communication can foster trust and encourage participation. Tailoring the outreach efforts to different investor segments, e.g., accredited versus non-accredited, is also important. A well-executed marketing campaign can significantly enhance a project's visibility and attract the necessary capital. It's about telling a compelling story and connecting with the right audience. Transparency and consistent communication are key. Role as crowdfunding platforms. Crowdfunding platforms serve as crucial intermediaries, facilitating the connection between real estate developers and a vast network of potential investors. These platforms provide the technological infrastructure, legal compliance frameworks, and administrative support necessary to execute a successful crowdfunding campaign. They typically offer a suite of services, including project listing, investor onboarding, payment processing, and ongoing investor relations management. Platforms conduct their own due diligence on projects before listing them, adding a layer of vetting for investors. They also ensure adherence to relevant securities regulations, guiding both developers and investors through the complex legal landscape. For developers, platforms offer access to a pre-existing investor base and streamlined operational processes. For investors, they provide a curated selection of opportunities and a standardized investment experience. Choosing the right platform is a strategic decision, depending on the project type, target investors, and desired level of support. Their role is indispensable in scaling the crowdfunding model. They act as trusted marketplaces for real estate investment. Investor relations and reporting. Maintaining strong investor relations and providing transparent, timely reporting are crucial for building long-term trust and fostering repeat investments in real estate crowdfunding. After a campaign closes, developers must establish clear communication channels with their investors. Regular updates on project progress, construction milestones, financial performance, and any significant challenges are expected. This can include quarterly reports, newsletters, or dedicated investor portals. Financial reporting should detail revenue generation, expenses, and distributions, ensuring investors have a clear understanding of their investment's performance. Transparency about both successes and setbacks is vital. Proactive communication helps manage expectations and addresses concerns before they escalate. Good investor relations can transform one-time investors into loyal supporters for future projects. It's about nurturing relationships beyond the initial capital raise. Effective communication builds a strong community around the developer's brand. It demonstrates accountability and professionalism. Project management and oversight. Effective project management and diligent oversight are essential to ensure real estate development projects funded through crowdfunding are completed on time and within budget. This involves meticulous planning, coordination of contractors and suppliers, and continuous monitoring of construction progress. Developers must implement robust project management methodologies, utilizing tools for scheduling, budget tracking, and quality control. Regular site visits, progress meetings, and detailed documentation are critical for maintaining control and identifying potential issues early. Transparent reporting on project status, including any deviations from the original plan, should be communicated to investors. A dedicated project manager with proven experience is often key to success. This oversight extends beyond physical construction to include managing regulatory approvals, permits, and compliance throughout the development cycle. Strong project management minimizes risks and maximizes the likelihood of achieving projected returns. It's about disciplined execution and accountability. This ensures investor confidence is maintained throughout the project's lifespan. Managing distributions and returns. Effectively managing distributions and returns is a critical aspect of post-funding investor relations in real estate crowdfunding. For debt-based investments, this typically involves regular interest payments according to a predefined schedule, followed by the repayment of the principal at maturity. For equity-based projects, distributions may include a share of rental income, if applicable, and a portion of the profits generated from the sale or refinance of the property. Developers must establish clear processes for calculating, reporting, and dispersing these funds to investors. Transparency in these calculations is paramount, ensuring investors understand how their returns are derived. Any delays or changes in distribution schedules must be communicated promptly and clearly. Utilizing secure payment systems and providing detailed statements are essential for maintaining investor trust. The goal is to deliver on the promised returns and ensure a smooth, professional experience for all stakeholders. This reinforces confidence in the crowdfunding model. It's about fulfilling financial commitments and demonstrating project success. Common exit strategies: sale refinance. Real estate crowdfunding projects typically have predefined exit strategies, which outline how investors will realize their returns and how the developer will conclude the project. The two most common exit strategies are property sale and refinancing. A property sale involves selling the completed and stabilized asset to a new owner, such as an institutional investor or another developer. The proceeds from the sale are then distributed to investors, often including their initial capital plus a share of the profits. Refinancing involves securing a new long-term loan on the stabilized property, using the new loan proceeds to repay the crowdfunding investors. This allows the developer to retain ownership of the asset while returning capital to investors. Other less common strategies include holding the property for long-term rental income or converting it into a REIT. The chosen exit strategy significantly impacts the project's financial projections and investor expectations. It must be clearly communicated in the offering documents. A well-executed exit strategy is the culmination of a successful development cycle. It provides the final realization of investment value. Legal and tax implications of exits. The chosen exit strategy for a real estate crowdfunding project carries significant legal and tax implications for both developers and investors. Legally, the process of selling or refinancing a property involves various contracts, disclosures, and regulatory filings that must be meticulously handled. Ensuring clear title transfer, satisfying all loan obligations, and adhering to securities laws regarding investor payouts are critical. From a tax perspective, investors will typically incur capital gains taxes on their profits from a sale, or ordinary income tax on interest payments from debt investments. The timing of these events can influence tax liabilities. Developers also face tax considerations related to property sales, depreciation recapture, and entity-level taxation. Consulting with legal and tax professionals early in the planning process is essential to optimize the exit strategy and minimize adverse financial consequences. Proper structuring can lead to more favorable tax treatment for all parties. These considerations are complex and jurisdiction-specific. They require careful planning to avoid unexpected costs. Future trends in real estate crowdfunding. The real estate crowdfunding landscape is continuously evolving, driven by technological advancements and changing investor demands. Several key trends are poised to shape its future. Firstly, the integration of blockchain technology and tokenization is gaining traction, promising enhanced liquidity, transparency, and fractional ownership of real estate assets. This could further lower investment barriers and streamline transactions. Secondly, artificial intelligence and machine learning are being increasingly used for more sophisticated market analysis, risk assessment, and personalized investment recommendations. This will lead to more efficient and data-driven decision-making. Thirdly, there is a growing focus on sustainable and impact investing. With more crowdfunding platforms specializing in green buildings or community development projects. Finally, regulatory frameworks are likely to continue adapting to these innovations, potentially leading to more harmonized international standards. These trends suggest a future where real estate crowdfunding is even more accessible, efficient, and aligned with broader societal values. It's a dynamic sector with significant growth potential. Staying informed about these trends is crucial for all participants.